Hi guys, it's me. It's Kathy with Single Mom Advice, and I've been away for a little bit. I had a bout with cancer earlier last year, actually, and on the mend, doing well, getting my strength back every day. But I've had a request for some help with bad credit for some folks who wanted to try to buy a home. Okay, so one of the things that I wanted to go over just a real high level to get you started is what you need to do to work on your credit to help repair your credit. Okay, so there's a few things that I recommend. Now, this is what I personally recommend. This is something that I've actually done that went well for two reasons. One is the amount of time that it took. It was worth the investment, and that's regarding the monies that you're going to spend to get where you want to go. And also because of the opportunity to work directly with the credit bureaus. So jumping right into it, one of the first things I would recommend, and I'm not sure if this is going to come out backwards, my video camera's not working today, I'm using my phone, is that you actually sign up with the three reporting agencies. So it's Equifax, TransUnion, and Experian. And if you go online, set up an account, pay the monthly fee, you're going to get something that you won't get if you just file for a free credit report. A free credit report is not going to give you your scores. Okay, the one that I pulled gave me all of my credit history, which was very helpful if I knew how to read it. I don't expect that you're going to know how to read it, okay, or what that information means. And then what do you do with it? You've got this free copy, now what? So in signing up with these three, and it's about, I think it's $19.99, so $20 a month for each one of those. It's going to show you what they're reporting, and that gives you the opportunity to work directly with them to submit any of those that are actual errors. Okay, so this is not an opportunity for you to try to get out from something that you actually owe. Okay, you're not disputing something just to see if they'll make it go away on your credit report. These are things that are actually incorrect on your report. Okay, so you can do that directly when you have an account with them. Secondly, when you sign up, you're going to be able to get their app right on your phone if you want to, or if you'd rather just do it on your computer or laptop at home, you can access the information. You can mark where there are errors and dispute those actual errors. You can see when they get updated, and you can get your latest scores each month as they're rolled out. Okay, so and you say, well, why do I want to spend $60 a month? If you're going to buy a home, which was the reason for starting this video today, if you're looking to buy a home, you need to know what the lender is going to be looking at. You can go directly to a lender if you trust them implicitly and have them pull your credit for free. They're going to get your scores. They're going to tell you exactly what to do. Okay, so that's the easy way to go. If you want to work on this and you have time to see what's out there and what needs to be corrected and what needs to be updated and how you can increase your score, this is the way to go about it. Okay, so the next thing you're going to see is when your score begins to go up or goes down, and why. Because each of these companies are going to give you information on what makes your score go up, what makes your score go down, and that'll be helpful as well. But generally speaking, you want to have your scores at least in the 600s. Okay, if you've got a 400 score, something's wrong. Maybe you only have old unpaid medical bills. So they're looking for a couple of things. They want you to have good open lines of credit, paid on time, okay? And you want to get rid of your bad debt as well. So if you've got something out there that's dragging your scores down, you want to get rid of those. But you also want to have some credit established. And it's all about time and risk layering. So the longer you have the credit established that's good, the higher your score goes, right? That makes sense. And the older something is that goes unpaid, obviously that drags your score down. Now, having an open line of credit is not all that it takes to make your score go up. You say, well, I pay it every month on time. Well, that's great. Except another item that will bring your score down is if, let's say, for example, you have a credit card with a $1,000 line available to you. Okay, that's the most you can charge on that credit card. and you've charged $900 on there. That's going to drag your score down because, again, this is more about the risk layering that the lenders will do, that the scoring actually, FICO scoring does. And it says you're too close to the amount you have available. The less you need it, the more they'll give you in the way of credit. Okay, I know that seems crazy, but that's actually how it works. So for starters, when you're trying to review your credit and say, how can I make my score go up? Take a look at those good lines that you have that are open, that you've paid on time, and take that total amount available to you, okay? And find out what 25% of that is. What's 20% of that? So just take that number, multiply by 0.2. That's the amount, the most you should have spent as a balance that you've used on that card, okay? As that goes up, your score goes down. Okay, again, so in the $1,000 example, you've spent $900, your score's going down, you're saying, but I'm paying it on time, but that is the actual issue with that, okay? And on a previous video, I talked about the mix. So many folks have student debt, they have student loans. If you've got a mortgage, if you've got a couple of credit cards, you know, that's a mix of types of credit, and car payment and installment loan, that sort of thing. So that's a good mix. If you have just all medical bills, again, that's not going to help your score. Okay, so and there's two ways of looking at credit. One is that in order to get it, you're obviously in debt. Okay, so is that ideal? No. You'd like to be able to manage what you have coming in from your work, right, and spend some of that on fun stuff, give some of that away, and put some of that away as well. But if you're giving it all to the creditors, then you don't have a whole lot left over. Okay, so it's really about balance, but you have to be able to show to the lender, if you're going to buy a home, that you have the willingness to repay it, and that's what your credit report shows. So your ability to repay is your income. You know, how much money do you have coming in, and then how much you have going out, and that's debt to income ratio is on another video. We'll talk about that another time. But I just want you to please consider signing up with the agencies online, get the app on your phone, and over time you will see what kind of a positive impact it can have. You'll know what your scores are before you go to look for a home, and it'll put you in a better position for being able to get better rates. If you can also take this time to put some money aside for your down payment, that's ideal. I understand that's not an option for a lot of folks, but that will put you in a much better position. You are going to need some money when you go to buy a home, okay? So whether it's paying for your appraisal up front, because that is a third-party charge, those folks have provided a service, and whether or not you close is irrelevant to them, okay? So you're going to need some monies up front to be able to get into a home. So these are things to think about. This is your first step in taking a look at your credit. And also, I just wanted to tell you that in signing up for these, it's not going to pull your score down. I've heard over and over again over the years, and working in mortgages, folks will say, well, I really want a home, but I don't want you to pull my credit because I don't want it to lower my score. Well, the lender's going to have to pull your credit, or they can't work with you at all, okay? And they would have to pull it a lot in a short period of time for it to make that big of an impact on your score, okay? So don't worry about that. If you're serious about buying a home, they're going to need to pull it. You can do this first, and it will not reduce your score. Okay, so again, that's the only reason why I mentioned that. I'm not getting any kind of a kickback from any of these folks. I don't get paid from any of these agencies. I actually did this personally. It worked out really well, and it also helped me when I was building a home, because, you know, as you know, it takes months to have a home built. And I wanted to keep track of what was happening with my credit during that time, because from the beginning to the very end of that process, I needed to make sure my credit was in good shape, okay? Till the home is completed and everything's taken care of, signed off on, and I've moved in, you need to make sure that your credit's in good shape, okay? So that allowed me to do that because, as I said, monthly, I got my scores, and I could see any activity. I also signed up for alerts. They would alert me if anything had changed or happened across the bureaus. So that was really helpful as well. And I think that's it for now. So thanks very much. See you again soon.